Hey, quick video today on something I get asked about a lot, especially right now. Is it worth it to buy a rental property in the Inland Empire in 2026? Now, as you may know, I'm an investor myself. I have a handful of rental properties in Riverside and San Bernardino counties, and I'm in the process of acquiring another one. So this topic definitely hits close to home for me. First, why does the Inland Empire still make sense as a rental market at all? A few reasons that haven't changed. Entry prices here are still significantly lower than LA or Orange County, and rents haven't dropped at the same rate. That gap is where cash flow comes from. You've also got a large, stable workforce in logistics, healthcare, and manufacturing driving rental demand across cities like Moreno Valley, Perris, Riverside, and Menifee. And as the World Logistics Center continues to expand, as well as plans for future development, there will be even more demand for local, affordable housing. Additionally, there are still people moving inland from the coastal cities because they can't afford to buy or rent there. That demand is real, and it's not going away. Now, what does the market actually look like for investors right now? Cap rates on stabilized properties are running roughly in the high 4% to 6% range, depending on property type and location. These are move-in ready, already rented, or easy-to-rent homes. Value-add properties, which are the ones that need work, tend to be closer to that 6% and sometimes even higher. New multifamily construction is slowing down in 2026, which is actually good for existing rental owners. Less new supply means less competition for your units, and rents are expected to tick back up this year. And lastly, vacancy rates in the region are still below the national average. The demand is there. The question is whether your specific deal pencils out or not. But here's what you actually need to pay attention to. First off is California's AB 1482. That's the statewide rent cap law. It limits how much you can raise rent on qualifying properties, which is currently capped around 7.5% per year. Not every property falls under it, but you need to know before you buy. I know that's not the fun part, but it matters a lot. Next is interest rates. They're still elevated, so that affects your monthly debt service, which directly compresses your cash flow. The deals that made sense at 3% don't automatically make sense at 7%. You have to run the actual numbers at today's rates, not the rates you're hoping for. And lastly, you need to look at property management. If you're not going to manage the property yourself, build in about 8 to 10% for a management fee from day one. A lot of first-time investors think they can handle managing the properties themselves and then realize they can't, and now have an added expense they didn't originally account for. Plus, depending on how many units you have, managing all the individual units, tenants, maintenance, and utilities can be very time-consuming, so it may not be worth it for you to oversee it all. Just know what you're signing up for. So, bottom line, is it worth it? If you're a long-term investor looking to hold for 10 to 15 years, build equity, collect rent, and let the asset appreciate, then yes, the Inland Empire is still one of the better places in California to do that. If you're expecting fast, easy, passive income with no work and no risk, that's not what this is. And honestly, that's not realistic to what owning a rental is. The people who do well here are the ones who buy something that cash flows from day one at conservative numbers. Treat it like a business and hold it. If you want to talk through a specific deal, or you're trying to figure out whether the numbers work for something you're looking at, I'm always happy to run through it with you. Thanks, guys. We'll catch you later.